there is this eternal debate which I want to address because a lot of investors get confused by this. I suddenly get a call. I opened Economic Times, I opened some other paper, and they say, sometimes they say systematic investment is better than lump sum. At other times they say lump sum is better than systematic. This whole thing is so crazy because lump sum or systematic are not investments. They are not investments. They are not stocks or bonds or real estate for that matter. They are only methods by which you invest. They are only methods by which you invest. Let's look at this a little bit. Studies have shown that over the long term, lump sum buy and hold strategies in equity mutual funds perform better than systematic strategies. This is fine in theory, but these studies do not focus on how many investors have had the courage to hold on to their investments in bad times. Like we saw in that last example, if somebody made a lump sum of 4 lakhs and suddenly one day sees my 4 lakhs is 1,56,000. Instead of putting in more money as they should do at that time, what they'll be doing is, at least let me safeguard this 1,56,000 because today morning's paper says that the stock markets are going to close, which means I may lose 1,56,000. So let me get rid of it. The moment they get rid of it, the markets start to rise. So this tragedy has played itself out many times in many different countries. So there's a lot of this useless theory going around whether lump sum is better, whether systematic is better. These studies do not consider the vast number of investors who have redeemed equity mutual fund investments at the bottom of the market in a panic. These studies do not consider the returns if systematic investments are doubled once the index falls by more than 25%, or for that matter quadrupled if you have got them down at 50%. What if you increase it at that time? Such studies do not consider these things at all. These studies demonstrate the difference between research and investment advice. Investment advice takes into account the psychological and behavioral patterns of an investor and how they may affect investment. Research, on the other hand, is mainly statistics and mathematics. Ultimately, when you are advising a human being, all human factors have to be taken into account. Financial journalists can just run anything they want into Excel sheets and then if need be tinker with those Excel sheets also to get the kind of thing that they want to prove. What happens in real life is different. I once was advising a simple mechanical engineer, total youngster, maybe I don't think he was aged more than 25. He probably graduated at something like 22 or so, had worked in a company for 2 years, had just changed a job at a higher pay and was about to join the new company, had come to me with what his pay package is going to be, etc. And the first thing he asked me is lump sum better or systematic better? I said, why do you ask this question? No, I was reading today's paper. I said, okay. How much lump sum do you have? I have no lump sum. What do you mean by whether lump sum is better or systematic is better? Why do you worry about what the world is debating? How is it relevant to you? You are going to be earning from tomorrow. You are going to be paid some amount. You are going to have your expenses. Try to figure out your income. What is the provision you have to keep for tax? What is your company going to deduct from your income? What is ultimately going to land into your bank account? Next, you have already been working in a particular city for some time. Do you have a handle on your normal expenses? Can you give me these two figures? Income, net income, and expenses. Then we will see what surplus is there every month. That surplus, how we channel it into good investment. This is what should worry you, not whether lump sum or systematic is better. Because all you have got is only money for systematic. So sometimes the very need of the investor is not taken into account by anyone. What is written in the papers or the magazines is just a general article. And the headlines are also crafted in such a manner that they try to seek your attention. So we have to be careful of things that are not relevant to us. There is a whole lot of things, a trillion things that are irrelevant. What is relevant to us, to me, as I sit today, to think about an investment strategy, to think about an investment course. This is important. Therefore, what works in research may not work in real life. Every good investment advisor knows how difficult it is to convince an investor who has lost money to invest when the market is down. You have no idea about how human beings can think. A youngster had lost his father, and I was sorting out some of his papers. And then this youngster tells me, I'm working, I'm earning, I also need some advice on investment. When I went through his figures, this man was earning very well. And the kind of monthly surplus that he had was more than enough for a good systematic investment by purchasing stocks directly. Mutual funds were not required. The moment I suggested that to him, he got scared. He said, no stocks. No stocks? No. Why? No, I don't want stock. I'm scared of the stock market. I kept trying to probe why he was scared of the stock market, because unless we identify that fear, what about the stock market is causing him panic? There was no way either he was not prepared to discuss with me, or my skills in eliciting that information were inadequate. Then I tried a different approach. I said, okay, do you have any problem with an equity mutual fund? No problem at all. Hang on. What's an equity mutual fund? An equity mutual fund is nothing but takes your money and invests in stocks. I'm telling you to invest in stocks, you're scared. You're not scared of an equity mutual fund. Then it suddenly struck me that there is some fear related with a particular share, as in a demat account or a physical share certificate. So immediately I asked him, have you or your family members have had any bad experience in the stock market? He said, yes. My dad always wanted to invest in the stock market, and he had gone to a broker. And the broker is supposed to be his dad's friend. With friends like this, sometimes you don't need enemies. So that man had made him trade in and out, day in and day out, and he lost money. And not only did he lose money, finally all he had in his hands were, this was in the old days of physical, some totally useless pieces of paper in the form of share certificates, either very low value or no value. And when his father was on his deathbed, he had constantly warned his sons, whatever happens, don't go near the stock market. Equity mutual fund is fine. Not the stock market. Not the stock market. So this was the fear of this boy in the kind of fear that he had in his mind about stocks. And for him, I told him, I didn't hide the fact that an equity mutual fund is also nothing but stocks. You're going through something else. And I then told him, let's not go to the equity mutual fund also if you're so scared. We'll go to a bond fund. Do you have any problem with only that income going to the equity mutual fund? After some time he said, okay, only the income, my principal is safe. The principal is safe. Not only that, I said, we will just send this income to the equity mutual fund for a brief time. About 3 months, 6 months, 1 year if you want. Then we'll review, we'll see what calamity happened there in the equity side. If nothing has happened, then we'll go a little longer. Only income. Only income. From that point, I slowly brought him up. Today he has a very sound direct equity portfolio. All the fear is gone. Slowly he realized the difference between speculation in the stock market and investment in the stock market, that there were two different things. And he also realized the tragedy that happened to his father. Why? His father was not a gambler. His father was not a speculator. His father approached a friend who was a stockbroker for advice about investment in the stock market. That chap totally perverted this person's need into one of speculation, where he could make the most money, as a result of which he had a bad experience. He ran away from the stock market and he did his best to see that his children also run away from the stock market. So this is the kind of tragedy we know. Every advisor will know how difficult it is to convince someone when you have lost money. On the other hand, it is quite easy to convince an investor who has not lost money to make greater commitments to equity when the market is down. The same case that I told you about the 4 lakh investment. He's come to me in July. Probably at that time his investment value was higher. And he asked me, what do we do now? I said, listen, the indices had hit something like 61% down, but we are still 50% below the last peak. Out of your remaining some 3.5 lakhs, at least some 2 lakhs, you just transfer one shot to equity. You know what his answer was? Where do I sign? Why? He has not suffered a loss. He is not bothered now. He has not suffered a loss. He knows that the newspapers are saying something, the TV is saying something, his neighbors are saying something, his friends are saying something. The fact is that he has not suffered a loss. So, when he has not suffered a loss, because of some advice given to him, when the same advisor is now telling him, okay, let's make this one change, take advantage of still the index is 50% down, sign this paper, let's put at least 2 lakhs back into, I would have put everything, but for your sake, okay, let's put some, he's ready to sign. He would never have done this had he been in the other position where 4 lakhs had become 1 lakh 56. Now I tell him, oh, 4 lakhs has become 1 lakh 56. Listen, this is the best time now to invest in stocks. How much do you have in your account? Why don't you put there? He's saying, are you crazy? First of all, you have made my 4 lakhs become 1 lakh 56. Now the rest of my money also you want to keep it down this way. No argument that you can give about history, statistics, mathematics will ever convince someone, because nothing can dislodge from his mind the fact that my money has been more than half wiped out. Nothing can dislodge that from the mind. You can say whatever you want, it is like water off a duck's back. In my mind it is, what a loss I suffered. And conversely, in the other case, where there was no risk, mind is, okay, I don't know what these people are talking. What is this global financial crisis that people are talking about? Because it has not affected me. So we don't understand what they are making a big hue and cry about. So now I tell him, invest more in equity. Yes, okay, let's do it. Because obviously whatever you are telling me to do, I'm not going to suffer a loss. Very quickly, to go back to this slide. Why is it so important to be cautious? I've presented this before, but just in context. Comparison of 2 simple investments. One investment, you put 10,000 rupees and it grows at 5% return per annum. Very humble 5% return per annum. No risk at all. Totally safe. Second investment, you put 10,000 rupees. In 1 year's time, it comes down 50%. 10,000 becomes 5,000. But from this point, it grows at 10%. It grows at 10%. It takes 18 years for the 2 points to meet. So you suffer a serious loss. Just to catch up will take a long time. Just to catch up will take a long time. And here, of course, you have this trauma. Most people who suffer this loss will try to get out here. They will not even then try to continue the investment. So, Peter Lynch says, in many ways, the key organ for investing is the stomach, not the brain. What is your stomach going to do when an investment your brain selected declines for a year or two? Is that going to cause us anxiety? Is that going to cause us fear? Is that going to cause us worry? Even psychologically, it is not good. Your investments should be comfortable. You know who is a good investor by my definition? A good investor is somebody for whom, whether it's a PPF account, equity share, government bond, bank fixed deposit, money lying in an SB account, or an equity mutual fund, none of them cause him more anxiety. One does not cause more anxiety than the other. I'm equally comfortable with all of them. that person is a good investor. And you can reach that stage only when you have got absolutely sound risk management strategies in place. Otherwise, this kind of thing that can happen to you. What is your stomach going to do when an investment your brain selected declines for a year or two? I believe that this was the best stock to buy. So I put 1 lakh rupees into this stock. Now that 1 lakh has come down to 60,000 rupees. Only 2 years have passed since I bought the stock and it has come down to 60,000. I also know that this is not just the stock. The whole market has come down. We have a recession. That also my brain tells me. My brain told me that this is a beautiful stock to buy 2 years back. Shouldn't that same brain tell me general market is down? This stock has come down by roughly the general market. So this should be a very good opportunity for me to put another 1 or 2 lakhs into the same stock. This is what my brain should tell me. No. Why? Brain has been disposed of. Now the stomach is in control. There's been a transfer, like one bank manager is gone, next bank manager has come. Same thing. Brain is gone, stomach is now come. Stomach is saying, are you crazy? Already you're not happy with your 40% loss. You want to now increase your loss. Get out and protect that 60,000. This is the kind of thinking that investors do. Peter Lynch, the key to making money in stocks is not to get scared out of them. It's not to get scared out of them. I always will return to this. Don't get scared out of stocks. Start with zero risk. If you're a novice investor, let everybody laugh at you. You start with zero risk. Then you see where you want to go and how high you want to go. And you don't even have to go to half the ladder. Remain in the lower 1/3 or 1/4 and you'll be very happy. So this is such a beautiful saying in the context of investment. Let's just read it once again and then proceed. All of the great leaders have had one characteristic in common. It was the willingness to confront unequivocally the major anxiety of their people in their time. This and not much else is the essence of leadership. I want to be an investment professional. I realize that whether they say it or not, the major anxiety of my clients, my followers, the people who are depending on me for advice or for suggestions, their major anxiety is risk. Let me take care of risk. Case closed. This is leadership in financial services. Moving to another topic, real estate and index mutual funds. Real estate is a growth avenue of investment, there is no doubt about it. The time horizon is 10 years. 10-year systematic investment plans or systematic transfer plans would be the best way to invest in real estate mutual funds when they start operations in India. They have not. The true real estate mutual funds have not started operations in India. We have a very unsatisfactory system of real estate transactions in India. High stamp duties, presence of black money, so many other things. Sometimes title also, people's title can get questioned years after you purchase a property. So all these things. So these real operations have not started. SIPs or STPs in real estate mutual funds may require much greater investor discipline because as per current regulations, real estate mutual funds are close-ended and exchange traded. You can't go to the mutual fund and buy or sell. You have to only do it on the stock exchanges. As per the current regulations, we hope things change. Over long periods, 10 years and more, the returns from real estate mutual funds could well be the same as those from equity. Such funds will provide diversification across financial and physical asset classes.